Chevron's headline EPS looks like a monster beat, but 1.4 billion of it came from timing gains that can reverse next quarter, and the underlying quarter is still excellent. We are doing this video in two parts. First, I'll grade the report, then walk you through how I'd trade it. This is Chevron, ticker CVX, for the second quarter 2026. This is not financial advice. Everything in this video is just my own opinion for educational purposes only. Trading involves risk, and your results may vary. Revenue came in 12.33% ahead of estimates. That's a big number for a company this size, and it's riding a huge tailwind. Brent crude went from $68 a barrel last year to $104 this quarter. And on EPS, they beat by 14.99%. But here's the catch. About $1.4 billion of that came from timing effects that can reverse in future quarters. Strip that out and clean operational EPS was closer to $5.35. Still a strong beat, just not the headline monster. So on the beat itself, and I'm grading against the clean numbers, not the timing inflated headline. This earns a B, a solid double-digit beat on the top line and a real operational beat on the bottom line, just knocked down a notch because the reported EPS was flattered by reversible gains. And on consistency, this earns a C. Chevron's beat history is mixed. They benefit heavily when oil runs, and they miss when it doesn't. So a big beat in a $104 Brent quarter doesn't reset the pattern. Production hit a record. Over 4 million barrels of oil equivalent per day, up 20% year over year. U.S. upstream set a record too. That's the Hess deal, the Permian, and the Gulf all firing at once. Cash generation was the standout for me. $22.6 billion of operating cash flow, and they used it to pay down $8.4 billion of debt in a single quarter. That's a record. Their net debt to cash flow ratio dropped from 1.3 times to 0.6 times. They also hit their $3 billion structural cost reduction target 6 months early, and 70% of those savings came from durable efficiency gains, not one-time cuts. That's the kind of margin improvement that sticks around after the oil price tailwind fades. On the Hess integration, they've captured $1.5 billion of synergies within a year of closing. That's 50% above their initial target. Deals like this often disappoint on synergies, so this is genuinely impressive execution. And the strategic one. They signed a 20-year power purchase agreement with Microsoft, which is a fixed-price contract to deliver 2.67 gigawatts of electricity at their Kilby project in West Texas. Management is guiding to mid-teens returns and says more hyperscaler customers are already in talks. So on profitability, this earns an A, record cash flow. Cost targets hit early with durable savings. Synergies 50% above plan, and a new high-return power business layered on top. This is the margin story that matters for anyone holding Chevron Corporation for the long haul. The headline, EPS of $6.11, was flattered by $1.4 billion of timing effects. That's mark-to-market gains on derivatives before physical delivery, plus inventory accounting quirks. Those can reverse in future quarters, so the clean number is meaningfully smaller. The biggest risk I see is the Caspian pipeline. That's the main route for Chevron's roughly 1 million barrels a day of Kazakhstan production. When analysts pressed the CEO on backup plans, he wouldn't quantify them. He admitted alternatives are not enough for an extended shutdown, and that's a live geopolitical risk sitting under the whole thesis. International downstream got hit by Middle East disruptions. Refinery inputs down 10%. Refined product sales down 13%. The partitioned zone between Saudi and Kuwait is still curtailed, and Strait of Hormuz shipping issues are constraining their chemicals business too. U.S. natural gas prices collapsed. Realizations at 91 cents per thousand cubic feet, down from $2.48 last quarter. That's a real drag on Permian and Gulf economics, even though the oil side is booming. On Iraq, that's the West Qurna 2 and Nasiriyah opportunity. Management confirmed the contracts are still being negotiated. Potentially billions of barrels of resource, but no signed terms. Real political risk, and no clear timeline on the export pipeline concept. So on guidance, this lands at a B. They held their CapEx range and delivered on cost targets. But the fact that power spend is now competing inside the same envelope, and Permian is at plateau, takes the shine off what could have been an outright raise. And on red flags, I'm at a C. The CPC pipeline exposure is the one that really weighs on me, because management wouldn't put a number on their contingency plans. Combine that with $1.4 billion of reversible timing gains flattering the headline, and there's enough here to keep me honest. Putting it all together, Chevron delivered a genuinely strong operational quarter, but the reported numbers need context. A big commodity tailwind and reversible timing gains did some of the heavy lifting. The stuff that really matters, though: record cash flow, record debt paydown, cost synergies well ahead of plan, and a brand new power business with Microsoft. That all stands on its own. The CPC pipeline risk is the one thing I can't dismiss, and it's the reason I'm not going higher. Overall, I'm giving this print a B. So that's my grade on the report. Now let's talk about what you actually do with it. I've broken this into 6 scenarios depending on where you stand. Whether you're looking to get in, selling cash-secured puts, holding shares, sitting on covered calls, holding leaps, or underwater, or thinking about adding, find the one that best fits your situation. Okay, let's get into it. Brent, sitting up at $104, is running hot, and the stock probably reflects that tailwind, so I'm not chasing this print. My preferred way in is selling cash-secured puts when oil pulls back, targeting strikes 5 to 10% below the current price with 30 to 45 days to expiration. The Kilby power project and the Guyana ramp genuinely widen the long-term story, so on any 10% or bigger pullback in oil, I'd look at leaps dated out to 2027 or 2028. So my stance here is I wait and I sell puts on the dips. When I set my strike floor, I assume Brent normalizes back down to $75 to $80, and anything I'd sell needs to survive that scenario without regret. Selling puts in the 30 to 45 day window during post-earnings drift or oil weakness gives me the best mix of premium and margin of safety. I avoid strikes so close to the current price that a routine oil pullback puts me underwater. The dividend and balance sheet make assignment survivable, but I want to be paid for the volatility, not assigned into a peak commodity print. My stance is I price my strikes for $75 Brent. This quarter validates Chevron as a core dividend and free cash flow name for me, and I'm holding with conviction. Kilby adds a real growth vector that wasn't in the story a year ago, and the $8.4 billion debt paydown plus 0.6 times net debt to cash flow gives management huge flexibility for Iraq, Venezuela, or more power deals. I'd only trim on meaningful strength, meaning 10% or more above current levels on continued oil spikes, since current Brent is likely above mid-cycle, and some mean reversion feels likely. So my stances hold, and I only trim on real strength. If these were my covered calls, I'd be careful about capping the upside too aggressively given the Kilby optionality and the pipeline of additional power deals management flagged. If I'm short calls near the money, I'm rolling strikes further out of the money and further out in time. Chevron with a power growth vector isn't a pure mean reverting oil name anymore. And if the Microsoft Power deal gets followed by another named hyperscaler over the next 60 to 90 days, the stock could reprice hard through my strikes. My stance is roll up and out and protect the upside. My long-dated call thesis just got stronger because I've now got 3 value drivers instead of just oil price beta. There's legacy production growth from the Permian, Guyana, and Bakken. There's the Kilby power business with mid-teens returns and cash flows independent of oil. And there's the cost story with $3 billion structurally taken out. I'm holding what I own, and if I'm sitting in shorter dated calls, I'd look at rolling out to 2028. The Iraq and Venezuela optionality management flagged is free upside not in the models. My stance is hold, and I consider rolling to 2028. If I were underwater on Chevron, this print unambiguously validates the story for me, with record production, record cash flow, record debt paydown, and a new growth vector. I've got real support from the $1.78 quarterly dividend, which yields well above treasuries, and a balance sheet that can absorb multiple years of lower oil. I anchor my add points to oil moves, not share price moves. If Brent dips into the $75 to $80 range and Chevron follows it down, that's when I size up rather than cut. My stance is add on Brent weakness, not on price. Bottom line, this print earns a B from me. Chevron just added a genuine growth vector on top of a fortress balance sheet, and that changes how I'd approach the name going forward. Thanks for watching.